Before I get started, just need to remind everybody, I'm not a broker-dealer or investment advisor, so when I look at these markets, I'm going to be looking at them from an educational standpoint only, not telling you to buy, sell, or hold any particular securities or giving any personalized recommendations. The markets always have risk of loss, and therefore, do not try to trade with money you cannot afford to lose. When we can do what we can to try to minimize the risk, and we're going to talk about strategies to do just that, but we can never eliminate the risk 100%. So again, just be careful out there. Also, I'm not subject to any trading restrictions, so I could have a position in a security or initiate one at any time. Just be aware of that as well. So I got quite a few different programs that I run. Most of them are really focused more on futures than they are Forex, but honestly, the strategies work the same no matter what it is you're working on. Charting is charting. And it doesn't matter if you're charting Forex pairs like the yen and the pound yen, the beast, or if you're charting commodities such as crude oil, or if you're charting a stock like Tesla. Charts are charts. And really what you're looking at, if we go out and look at a chart, what we're trying to really look at here is what people's expectations are of a particular security. Are they bullish, expecting that security to go up in value? Are they bearish, expecting it to go down? And there's multiple participants in any market. And what we need to do is try to figure out, okay, who's really in charge of this price movement and where are they going to be pushing prices? Are they going to be making it moving up? Are they going to make it move down? Depending on, again, their perspective of those markets. And one thing that I do every now and then is I go out to look at, and I'll use this, you can actually go to different platforms for it, but bar chart, I go to futures, and they have what's called the Commitment of Traders Report. Now, you can actually go and get the raw data at cftc.gov. That's the federal government for the United States. That's their website, Commodity Futures Trading Commission, that really tracks futures trading. But you got to remember, when it comes to Forex, many of the currency pairs are traded as futures. So you can actually see, and I'll go into this right here, Commitment to Traders Report under Market Data and Economic Analysis. And basically, if I were to go into, just do the long format for the CME, and I can look for, let's just do yen. There we are, Japanese yen, Chicago Mercantile Exchange. And what happens is when it comes to the futures markets, there's two main groups of traders. You have what are called the reportable positions, and you have the non-reportables. The reportables are people who are trading in large enough size that they legally have to tell the market or the exchange, they have to legally tell the exchange every day what their positions are and how big they are. Are they going long? Are they going short? Are they doing something called spreading? Spread trading is actually something I do quite a bit as well. I actually teach it. And a spread is when you're trading one security against a related security. So in a way, Forex trade spread trading. If I was trading, as I mentioned, the beast, the Great British Pound versus the Japanese yen, you're trading one security against another, whether it's going up or down against that security. So anyway, getting back to this, with the reportable positions, those are the big players. We have, that gets subdivided into two groups, non-commercial and commercial. Commercial are entities. It could be a person, it could be usually it's an entity like a business or a brokerage that is trading in very large size because they are dealing with the underlying security in their everyday business. So if somebody, let's say Toyota, in this case for the Japanese yen, obviously Toyota, Japanese-based company, but they have plants all throughout the world and they distribute their product all throughout the world. Okay, so if they're collecting collecting US dollars from a plant in Kentucky in the United States, they want to repatriate it into yen to pay their executives in Tokyo or wherever their main office is, I'm not sure. So they have to worry about the value of the yen going up or down against the US dollar because they might be getting paid more or might be getting paid less. So they're actually trading the yen to help stabilize their accounts receivable in their business. So they fall under commercial traders. I'm not so concerned about them because most of the time they're just kind of hedging, again, against drops or rallies in the underlying price. The non-commercials are what I would usually want to watch. The non-commercials are the large speculators, the big traders. And what they're doing is driving the market. They're trading at such large size that their order flow can actually cause prices to go up or down. Non-reportables are us, smaller traders. And typically, if there's this report comes out every Friday, but it's actually from Tuesday's data. So you can see the most recent one was on July 3rd, because we haven't finished this week yet. And the data was from June 27th. So if you take a look at the dates, let's see here. Actually, that was showing July 3rd. That's a Monday. I guess because of the holiday, they had it set earlier. But again, it was for Tuesday, the 27th. That data should have come out on the 30th, but for whatever reason, it shows the 3rd. So we'll get another report coming out this Friday for Tuesday's information. But basically, what I want to see is what are the commercials doing? And you can see they are net short right now on the yen. Okay, you got the longs 41,000 versus shorts 159,000. Obviously, they're net short and they're overall bearish on the yen. Well, you look at the non-reportables, the small traders like us, and we were actually net short as well, although not as much. Well, that's normal, where we're both moving in the same direction. Everybody is expecting the yen to go to the downside, and therefore they're trading on the short. But if there's ever a difference between the two, who do you think you'd want to follow? Small traders like us or the big commercial, non-commercial reportables? The uh, big traders. Obviously, we want to follow the big guys, right? Let's see if we can find your. Take a look at the euro. That's euro pound. That's a cross pair. Let's see. Euro FX. There we go. Now this one's also the same. You can see the Euro FX, we've got net long by a large sum on the non-commercials and net long on the non-reportable. So again, they're both going in the same direction. They're all going long. So the price is probably going to the upside. Now I brought up that other web page right here, the COT on the bar charts, because if I go down to the currencies here, let's say we go to the Aussie, we actually get a visual representation of that same chart. So here we can see the Australian dollar, and we've got commercials in red, the non-commercials in green. Those are the large speculators, and that's what I want to follow. And then you got the small speculators like us in blue. Well, at any time, if those are in a different order where the large speculators in green are maybe going net long and the small speculators are going net short, you want to follow the pros. So this gives you an idea. Now it's delayed by about a week, but it can give you an idea overall who is driving a price movement. So if you're noticing that overall the price is moving down, but it's being driven by the small non-reportables, it's probably not going to last. Whereas if the trend is being driven by the large non-commercial traders, that's probably going to be sustainable, and you want to follow that trend. So I just brought that up as kind of a side note as we get into supply and demand and how it works, because again, I can follow pretty much any of these reports. British pound, for instance, right now we can see that the non-commercials are net long by a lot. Again, it's a visual chart of the trading that's going on the pound. And if the pound is going up, it's likely to sustain that move, even if the non-reportables are not as bullish as the non-commercials. So you always want to follow the big traders. And it breaks it down, again, a little bit more. You can see who's doing what. But typically, I'm just looking at this area and seeing who is driving us and in which direction, and is that likely to sustain itself. So the reason why I bring this up, let me go back here, is I want to talk a little bit about order flow. And order flow works the same way in futures or stocks as it does in Forex. Basically, we want to follow the big professional traders, because those big professional traders are the ones that are really driving price. They're the ones that dictate where the prices are going to go, either up or down. Okay, so basically, my background, if you're not familiar with me, I've been in the business for over 25 years, and I started off as a retail broker, which honestly I hated. I was on the sell side, and I worked for what they call penny pusher. So, people watch that movie Boiler Room or Wolf of Wall Street, and a lot of people, they look at that and it's entertainment to them. To me, it was actually my life for a while, where I pretty much did that penny pushing. We had to do what they call smile and dial. So you picked up the phone 300 times a day and had to call somebody up and try to sell them some stock. I hated it. because I really cared more about what my students were doing, or not students, but at the time clients. I cared about the portfolios. I wanted to make sure that what they were in was something that was appropriate for their risk tolerance. And it was going to do well for them. The broker was more interested in getting commissions and getting paid. So I ended up moving from the front office to what they call the back office operations. I became what they call an agency desk operator. And with the agency desk operation, what I was doing was dealing with the orders that came in from the brokers. So basically, a broker would talk to a customer, and now everything's done electronically, but it still works the same way. It's just electronic. You don't have physical, what they call chits. What would happen is if a broker talked to a customer and they got a buy order, they would write their order down on a piece of paper called a chit. And they typically use blue for buy orders and pink for sell orders. And these are just an example of some chits that somebody had. Mine were pretty similar. They weren't the exact same as what you see here, but they were definitely very similar. So, basically the chit would be given to the agency desk operator. I like to joke. I say every morning I come into my office, there's this huge pile of chit on my desk for me to deal with. But that was the order flow. Now, what you got to realize is when you're dealing with these big institutions, they are dealing with large orders. I was dealing with some retail orders. Somebody at home would talk to a broker and say, "Yeah, I'd like to buy a couple shares of XYZ stock," or, um, "I want to sell my 1,000 shares of this stock." So that was pretty easy. If you had small orders, those chits, basically what I would do is on my computer, and if you remember the old monitors, we had the CRT monitors. It was actually all green. If you would go back, you remember it was monochrome and it was all green and just pretty much text on the screen. So I would try to get those orders filled by communicating with a group of people called market makers. And I would try to get the best price for the brokerage and then pass along the pricing to my customers. But what we would try to do is skim a little bit off. If we could buy at a slightly lower price than what we gave the customer, we got to keep the difference. Plus, they paid us a commission to rip them off. I mean, they paid us a commission to get their orders filled. So that's what I was dealing with. On the floor of the exchange, it's very similar. I have many friends who actually used to work on the different exchanges, and what they would do is they would gather up their orders and kind of stack them up according to price. Now, I didn't only have retail customers. When I was working for the brokerage, I actually had some institutional customers, and their order flow was a bit different. When I was talking with the individuals, it was like buying or selling a couple shares up to a couple thousand shares. When we were dealing with the big institutions, when they would go in, they would buy a couple 100,000 or even a couple million shares. And the problem is you cannot buy all that at once. Even in the Forex market, one of the advantages that traders try to take again, in the advantage is they want to remain anonymous, especially if you're a big name. If you're a trader for Goldman Sachs, everybody's got their eyes on you. In the old pit days, they would wear jackets with their big, they had the pins that had the name of the brokerage on it and who they were, or codes. And basically, if you were one of those big players, they would watch you to see what you're doing. And that's not necessarily a good thing, because if you're trying to get a very large order filled, unfortunately, if you try to go in with that large order right away, everybody's going to see that order. And if it's likely to move the market, they will jump in front of you, do what's called front running, and they will try to buy before you can buy. And if that happens enough, they're going to drive prices away from the price you wanted. So instead, with big orders, institutional orders, you have to do what's called working the order. So you take that large order, break it into smaller pieces, and try to feed them in without getting noticed. So basically, what would happen is, again, if you were dealing with these brokerages and those orders, say you had a desk at the exchange. Actually, again, I already talked about this. My job was to get the orders filled, and I would try to route those orders to market makers, as I said, and then I'd fill the order and get a notification back to the broker. But this is where I wanted to get right here. When you have orders on the exchange or even in Forex, you don't have to raise your hand. If you got a question, you can just go ahead and ask. Just type it in. I'm watching the chat. But anyway, if you got orders, you would stack them up according to price, because that's what it means. Price is everything. Whoever gets their order in at a certain price, if prices match that, you get your order filled. If not, then they just sit. So I'm using just basic price here. Obviously, Forex works the exact same way. Okay, because again, I've got friends who used to work for market makers in the Forex markets. So for every person that wants to buy, there must be somebody who's willing to sell, right? You can't buy something unless somebody sells it to you. You can't sell unless somebody buys from you. So every order that goes out there that gets completed has to have somebody doing the contra. So right now, we got orders stacked up to buy at 29, 28, 27, 26, 31, 32, 33, 34 for the sell side. But what if you wanted to buy at 30 bucks a share? Right now, there aren't any, and there's nobody willing to buy or sell at 30 bucks. No, actually, the best price would not be the VWAP. The VWAP, or what they call volume weighted average price, that happens during the day. It's an average of all the prices and where the majority of where the majority of orders have been filled. So that's not necessarily the best price. However, with the VWAP, or volume weighted average price, that is kind of the benchmark for many of the institutions. If they can buy below that average price, then they've done well. Or if they sell above the average price, obviously they've sold better than the average. So they are better than the average. They did well. But no, that's something completely different than this. So right now, if we want to buy at 30 bucks, there is no one currently sitting at $30 willing to sell. So one of two things will happen. Either one, a seller will come out of the out of the air and decide I will sell to you 30 bucks and you'll make a match. Or a chit would be written up and laid there on the desk at 30 bucks, and you would wait to buy until someone decides to sell to you, period. That's it. Again, you cannot buy without a seller. So if nobody's willing to sell at 30 bucks, your order just sits there unfilled until somebody decides to sell to you. So instead, if you want to buy very quickly and you're not worried about, maybe you want to get a decent price, but you're not really worried about holding out for your price, you can sell. And that would mean you buy from 31, raise your bid. And that's what causes prices to move. If notice, but their price until they match. No, they want to go to thirds. And if the buyers are aggressive enough, they will pay more for the privilege of being able to buy that particular security. So you'll see that, right now there's still a bunch of people at 31. So if anybody else wants to buy, they would buy from 31. If all those orders were taken out, now if anybody wants to buy, they have to buy from 32. And that's where the orders would start being removed. And again, if all the orders are removed from 32, then we would buy at 33 if they're still aggressive and the buyers really want to get in. But you'll notice two things that are happening. Number one, what you see on the chart is the higher in price you go, the more sellers you happen to have. It makes sense, right? If you're willing to sell, you're probably willing to sell at a high price, and there's probably more people willing to sell at those higher prices. But what you don't see on this chart right now is the buying pressure, right? We don't know where the buyers are. They could be there at 31, 32, 33, 34. We don't know until they actually take action. But typically, when you think about it, it's common sense. The higher prices go, the more likely there are to be people willing to sell because they're going to sell for a profit. But the higher prices go, the less buyers you will find. And that just makes sense because, again, number one, they may have already bought at a lower price. That obviously satisfies their demand. Or two, they may not be willing to buy at a higher price. They may be wanting to hold out for their lower price. So as prices are going up, again, we're satisfying that demand by selling to those people, but we're running into a little bit of a roadblock. It gets harder and harder to go up because there's so many more sell orders coming in. And eventually, we're going to reach a point of complete imbalance. And what happens is, if there are a lot of people willing to sell, but now no one is willing to buy anymore, They either already bought at 32 or 33, even 31, or they're looking at 34 and saying, you know what, this security is not worth that. I'm going to wait and see if prices come back to me. For whatever reason, either all the orders got filled or there are no more orders. If there are no buyers now at 34, prices cannot go up. We still need those buyers to remove the sell orders that are in our way. So if you're sitting there wanting to sell at 34 and you've noticed, okay, people bought at 31, 32, 33, but now they're not buying anymore, you're probably going to get nervous. And what will eventually happen, especially if there's an imbalance like this, if you want to get your order filled and you're trying to sell at 34, there's nobody willing to buy. To fill your order, you might actually lower your price. Because we knew there were people willing to buy at 33 because they did. So that's what causes prices to change direction. If they're moving up and up and up, when we get a big wall of orders or even down, you move down, you can see you're getting more and more buy orders. At some point, you're going to run out of sellers. Either they already sold at a higher price or they're just not interested in selling anymore because the price is too low. They want to make sure they get something out of it. So if we reach that imbalance where we have too many sellers and no buyers, or too many buyers and no sellers, prices will stop moving in that direction and usually reverse because these nervous sellers will start lowering their price to get the orders filled, or the buyers will start raising their price in order to get their buy orders filled. And that's what happens. That's what drives the market. And this drives any market. It doesn't matter if it's stocks, futures, Forex. It doesn't matter. We're the same. Now, we can't see this order flow for two reasons. One, we're not at the exchange. You got to have a membership to get on the floor. And number two, it doesn't even exist anymore because everything's done electronically. But the orders still exist. We just see them in our charts. And if you can recognize patterns, that's a key thing. You got to be able to recognize the patterns on the charts that tell you where are the big imbalances between the institutional orders and the retail orders. That's what we're looking for, okay? I equate the large institutions to elephants walking through the jungle. And we're just small traders trying to get through the jungle on our own. You can try to walk through on your own with your own machete, hacking through the jungle. You'll probably get whipped by branches. It'll be very slow trying to get through. Or if you can find an elephant trail, you just follow them. They're much bigger than you. They'll clear a path for you. It'll be much easier. You just got to watch your steps so you don't step in the droppings, right? Big elephant droppings. Anyway, so we can follow these elephants. And by the way, it doesn't matter how big the elephant is, right? Those big institutions, as I mentioned before, they try to be sneaky and break up or work the orders in smaller increments, but they're still too big not to be noticed. No matter how small they try to break up their orders, they still leave footprints in the woods or in the jungle. Just like an elephant walking through the jungle will leave footprints even if it tries to tiptoe. So we, as traders, just need to identify those footprints so we can identify where the institutional orders are. So let's imagine here prices are at this area and all of a sudden they jumped out of that area. Okay, why did they jump out of that low, out of that area? Well, because looking back, you can see we have a huge imbalance. We have lots of buying orders, and this may be a very inexpensive price where there are no sellers. So the buyers had to be aggressive and raise their prices, and you can see we took out some orders on the way up. But the footprint was left behind. What happened here is we left that area very quickly, and basically what causes that pattern is there's not really a lot of sellers or any sellers in this area at all, right? We rallied out of that area very quickly. So the only reason why that happens is there was nobody willing to sell, so the buyers became extremely aggressive and pushed prices up so that way they could find sellers or attract sellers to sell to them. Well, if there were no sellers here before, what do you think would happen if prices come back to that area? There were no sellers there before. Unless something fundamentally changes, there's no reason for anyone to buy there again. Or, more importantly, anybody who did sell there. Think about that. How would you have felt if you sold at this low price only to see it go up? Would you be selling there again in the future? Probably not, right? If you saw, oh man, I sold at this area, but I could have sold up here. If prices return to that area, you're probably not going to want to sell again. So unless something fundamentally changes, you are not going to sell there, and there's not likely to be any other sellers there either. Exactly. Akira is saying you'd feel frustrated and sad that you sold at too low of a price. In fact, if you saw prices rally from that area very quickly, you'd be more inclined to buy in that area, right? It's just common sense and human nature. We want to get good pricing and feel good. We don't want to feel frustrated and sad. It's the pain and pleasure principle. Whenever we experience something that gives us pleasure, we try to re-experience that. If we experience something that causes us pain, we try to avoid that. Well, selling at that low price obviously caused pain in the past. We're going to try to avoid that and not sell in that area in the future. Well, what happened with this security is it was running to the upside, and there happened to be a huge stack of sell orders up here. So that's where it ran to and stalled out. Once again, if there's no buyers now in this area, but there's lots of selling pressure, we are likely to see a drop in price as those sellers become nervous and start to lower their prices they're willing to sell to be able to attract any buyers. And it'll keep going until it reaches the origin of the imbalance right there, back where we were. Now, our job as traders is to look at our charts and find where's the origin of those imbalances so that way when prices return to that area, we can buy. Now, are we going to be right all the time? No, of course not. We're not going to be right all the time. So if we're wrong, we have to put in a stop loss to protect ourselves. And we usually put that outside the level. And I'll talk more about those levels and how they're found. But, we take a look at any security. See, there's a euro dollar on a weekly chart. When we take a look at our weekly chart, we can find areas where there are patterns. Let's see here. Right in here, that looks like an area where there was lots of buying pressure, but no sellers. We jumped up very quickly on that weekly chart. And right now, we seem to be moving a bit to the upside. So we would look left and try to identify an area where there's an imbalance of sellers. And it looks like we're in one right now, right here. And notice this was the origin of a decent drop in price. As we came back there, we're being met with a lot of selling pressure, and we can't seem to break through that area. I can go into different time frames or even different securities. Aussie yen. And we'll go into, say, a 240-minute chart. Just going to remove drawings. There we go. And again, we look to see where's the origin of imbalance. And there's different patterns that we can identify that tell us where prices might turn. Can 104 be a demand area? Sorry, I'm not sure what you mean by 104. Was that on the previous chart or on this one? Oh, dollar yen coming from demand zone. Oh, I was looking at the weekly chart there, right? Oh no, I didn't have the dollar yen on there. Let me clean this up. 2-hour demand. I'm not going to keep going into individual things. I'm going to continue with my talk here, first of all, but I'll take a look real quick. 120 on a 2-hour. No, I don't know. There's a little bit of an imbalance there, but I don't think that's great. You're talking about this area right here. A little bit. I mean, obviously we had that spurt right there to the upside and it is bouncing. It's reacting to it. So yeah, there's a little bit, but honestly, I don't know if that's going to work long term because it had been there before. And you can see we might have used up all that buying pressure. So while we'll get a small bounce there, it'll eventually go through. And part of the reason why I say that is because my RSI is showing weakness in that area. So I'll go over that in a little bit. Anyway, that's order flow. We're just looking to see where are the leftover orders from the institutions and where are the imbalances. And that's why I showed you the commitment to traders to start with, because you can see The large traders are the ones that are really driving price. I didn't find a good example, but if you can, where you find on this community traders report where the non-commercials are doing completely opposite of the non-reportables, you'll actually see that prices tend to follow those non-commercials. So let me see if I go to Aussie. There it is, Australian dollar. Nope, that one's the same. Net short, net short. Okay, let's try pound. And hogs. Move this out of the way. Hmm. Nope, British pound. They're net long on the commercials, non-commercials, and net long here on the individuals too. It's when you got that opposite that usually works pretty well. Nope, peso, they're net long as well. Swiss franc. Nope, net short on both. But it kind of confirms the trend. Loonie. Nope, both net long. Yeah, this is the CFTC website, Commitment to Traders Report. So cftc.gov is where I went. And when you go to the cftc.gov, I'll type it in. What I'm looking for is right here, Market Data and Economic Analysis Commitment to Traders Report. And then if you go to the CME, right here, Chicago Mercantile Exchange, long format, that's where the currencies are. So if I go down, I think which one's first? I just forget. Just going to scroll down until you see the currencies. There it is, Looney's first one. I focus on the non-commercials. As I was mentioning, the non-commercials are the professional large traders. And then I showed you barchart.com also shows this under futures. And right here you can see commercials are producers, processors, users. So they are trying to hedge their actions. However, the non-commercials are the big speculators, the big traders. They're the ones you really want to follow because they're the ones that are driving the markets. They're the ones that are trying to trade based on price movement. So anyway, price is stalling out here because we have a big imbalance of lots of sellers, no buyers. And look at this, it fell right back. But where did it fall to? The origin of the imbalance. You notice a lot of these orders get filled along the way, but there's still a huge amount of buy orders left over from that institution. And because there were no sellers here before, if there's still no sellers in that area, these buyers become nervous and drive prices up again. The only difference is we're able to buy here because we saw what happened in the past. And if we're wrong, of course, we put in a stop loss. Okay. So it comes down to supply and demand. Basic economic terms. If you've ever taken a course, Economics 101, you'll hear supply and demand. That's one of the first things they teach, right? Supply is selling pressure. Demand is buying pressure. And this works better, by the way, than support and resistance. Support and resistance is actually a completely different term than supply and demand. It looks different on a chart as well if you know what you're looking for. So we need objective areas where we can enter or where we could exit the markets. That's it. We just need to find objective areas to get in or get out. And it doesn't matter what security we're trading or what time frame we're on. It really doesn't matter. It works, like I said, on anything. The nice thing about charts, they're fractal. Fractal means the pieces are the same shape as the whole. The rules that apply on the small time frames also apply on the big time frames. It doesn't matter if I'm on this chart of the dollar yen on a 2-hour time frame or if I take it all the way down to a 5-minute time frame. Supply and demand still works, and it appears on any time frame. We got a really good supply zone right up here. I haven't reached it yet. We're actually stalling out of this little area, which also kind of meets the criteria. So, and again, I can also take this up to a 4-hour time frame and use the same rules that I would use on a 5-minute. So it doesn't matter. Basically, we want to do what the big institutional traders are doing because they're the ones making all the money and making the right moves, aren't they? In a way, it's like anything we do as adults. If you come into a new career, you're doing something new, The easiest way to succeed is find somebody who's doing well and copy them. That's all we're trying to do is just copy the big institutional traders. Follow what they're doing because they're doing well and making a lot of money. So we need to have rules surrounding this. We can't just be arbitrarily picking areas to buy and sell. If we can have rules that tell us where to get in, where to get out, we can be more consistent. Also, if it's not working, we have a way to start repairing and fixing it. If I equate it to a car, if you don't know anything about vehicles, about cars and how they work, engines, electronic systems, when you're driving down the road and your car makes some weird noise or it shows the check engine light, if you don't know how to repair those things or even diagnose them, you've got to take it to somebody who does, a mechanic or somebody with the nice, was a PCM module to be able to read the motor and figure out what's going on. However, if you learn the mechanics of it and how it works, you can diagnose the problem. So that's what we need to do. We need to create a rule-based strategy that we can use. And if it's not working, not giving us the results we want, we now know where to start to be able to repair it. And that's very important. We need to have a set of rules that we follow. So coming down to the zones themselves and what are we looking for? I mentioned there are footprints that are left behind by the big institutions. And there's two types of zones: supply zones overhead that tell us where we're going to have that imbalance and lots of selling pressure. And we have demand zones where there's lots of buying pressure and an imbalance that push us higher. Now, inside of that, there's two types of candles. And again, this works on any chart, any time frame. We have what are called basing candles and we have leg candles. And don't get this confused with the three different parts of a zone. Okay, so real quick here, let me go to Word. Let's bring up a new Word document. So when it comes to candles, oops, why did I not type? Not responding. Oh. So when it comes to candles, basically we have two types. We have basing candles and we have leg candles. And when it comes to zones, we basically have three parts to a zone. One is the leg in, two is the basing, and three is the leg out. There we go. Now, when it comes to, and I'll get to these in a little more detail in a moment, but when it comes to basing candles, price moved sideways. No real momentum in this basing candle. However, in a leg candle, price showed momentum and it pushed in a direction. Let's say that with no momentum. There we go. Anyway, and what's periods after these? All right. So with leg in, these are three different parts of a zone. With a leg in, these will have to be leg candles. However, in the basing, you can have leg or base candles there. Doesn't matter. As the leg out, that also must be a leg candle. There we go. Be grammatically correct. Okay, so when it comes to basing, that's different than a base candle. Just be aware that this is the three different parts of a zone. It doesn't matter if it's a demand zone or a supply zone. You have three parts to it. And when it comes to candles, we have two different types of candles altogether. Either leg candles or basing candles. There you go. Now you can see a little better. So what are leg candles? What are basing candles? Well, I'm glad you asked. Let's take a look. It's pretty simple. With a base candle, again, they show no commitment to the trend. You have sideways movement or lack of momentum. With the leg candle, it shows that either the bulls are in control and we're moving upwards, or bears are in control, we're moving downwards. And there was a favor compared to with the pricing. Either we had a lot of bullish or bearish pressure. Okay. So looking at a base candle, it's very simple. A base candle is where the closing price of the current candle is inside the range of the previous candle. The range is basically the high and the low. That's it. So again, right here, basing candles, current close is within the previous candle's range. That's it. This is pretty simple, isn't it? So when we look at a base candle, we're closing within the previous candle's range. The previous candle's range includes the high and low. Doesn't matter how big it is, okay? If the close of the current candle is at the high of the previous candle or at the low of the previous candle, it's like baseball. Tie goes to the runner, they get the base. So there you go. It's a basing candle if you close at the high or low. Wicks of the basing candle can protrude above and below the preceding candle. That's fine. It's all about the closing price. You got to realize there are 4 prices on every candle: open, high, low, close. The most important price is always the close. And we do care to a certain extent the high and low, but really every candle represents a battle between buyers and sellers. And we want to know who won the battle. The buyers or the sellers? Are we bullish? Are we bearish? So just looking at examples here of candles, again, we got the range of the previous candle, high and low. Here we see the close of the current candles within the range. That's a basing candle. You look over here and you're like, wait a minute, this closed below the body. Yeah, it doesn't matter. The range is what matters. We closed on that red candle inside the range of the green candle. That's still a base. Here we actually went above it with the body or the wick. That doesn't matter. You can even go above with the body as long as the close is inside the range. When everything's all said and done, we could not get enough momentum to move higher or move lower at the close. That's it. That's a basing candle. Now the other one, again, it doesn't matter if it's green or red. Right here, we're closing at the high, but we didn't exceed it. Therefore, that's a basing candle because we ended up inside the range of the preceding candle. Okay, it shows a lack of momentum. Now the leg candle is just the opposite. It's where you close outside the range. So basically, current close is either above the previous candle's high or is below previous candle's low. That's it. Keep it simple. Get rid of this stuff. There we go. There we go. Just one of those lines in there. And finally, this one. Oops, dismiss. All right, so that looks better. That one left. Probably being too picky here, but that's it. So a leg candle is where you close either above the high or below the previous candle's low. So you're legging in a particular direction. Right here, you can see we opened inside, but the close was below the low. That is a leg. We leg down. Here, we actually protruded above, but closed below. Again, it's all about that close. We are outside and therefore legging down. Here, we're legging up. We have a close above the high. Again, close above the high. Doesn't matter what else happened. Close above the high. Doesn't matter what else happened. So when we go out to our current charts, happen to be on that dollar yen on a 4-hour time frame, and we just look at random candles here, and we can mark off high and low That red candle now is a base candle because it's closing within that range. We go to this one now, high and low. We look at the next candle. That's also a basing candle because it's closing inside the range. Go to the next candle. That's a leg candle because we are closing above the high of the preceding candle. That's it. It's very simple. Mark off the high and low. That's a base. It's closing inside the range of the preceding candle. Again, oops. Closed above, that is a leg candle. So there's no questions about whether it's a leg or a base, is there? It either closes inside or outside. So right there, there's a close inside the previous candle. That is a base. Yes, this is being recorded. There's another leg candle, closed below. Just keep going on each candle. Any chart, any candle, you can identify as either a leg or base. That closed inside, that's a base candle. Next candle, leg is just above. So that's it, leg and base. Pretty simple, right? If you close within the previous candle's range, you are basing. If you close outside, it's a leg. And we need to identify that because, again, when it comes to the three different parts of a zone, we need leg candles for the leg in and the leg out. However, basing could be either type of candle. So there's a big difference between a leg and base candle and the leg or base of a zone. Okay? You're welcome. Yeah. So moving forward here, institutional order flow, basically what happens is, I mentioned before, you'll get the institutions, what they do, and I did this again is for a living for a while, they identify an area where they're willing to buy or sell securities. That's what institutions do. They don't necessarily say, I'm going to pick this particular price and buy there, or this particular price and sell there. No, they pick a range where they're willing to buy or sell based on what they feel is a valuable or value area. I'm going to sell at this price level because that's where I think I need to sell before it drops. It's the highest value I'm willing to take for this security. Or I'm going to buy here because I think this is a good deal that makes it a good value to buy at this particular price. So they can't buy everything they want all at once. They usually put in a bunch of orders and they move prices because they're trying to buy or sell typically before everybody else does. So it causes that imbalance. And what happens is there are usually leftover orders that aren't filled right away. They wait for prices to come back so they could buy more in that range. It could take a few minutes, a few months, a few days, a few years. But they wait for prices to return to that range. And the more times that area is touched, the weaker it becomes. The reason why is, you remember, we're trading the first retest of an area where we saw the institutions were buying or selling because they're likely to have the most leftover orders now. But the more times you test that area, you're taking away orders that were in that area. So basically what it comes down to is there are 4 patterns that we need to look for to identify supply and demand. A lot of people charge you thousands of dollars just to learn this info, and here I am giving it away for free, right? I don't mind. Anyway, and like I said, if you're interested in learning more, you can definitely catch me on Twitter. That's probably one of the easiest ways, but you also, my email address, I can give that to you too. It's just Brandon Wendell.cmt@gmail.com. So there you go. BrandonWendell.cmt@gmail.com. Easiest way to get a hold of me. Or Twitter, at Trader BDub. There you go. Anyway, so looking at the first demand zone, this is where we're going to want to buy if prices return to that area. First, we have to have a leg in. So you notice this number 1 right here, the leg in candle is closing below the previous candle's low. So that's a leg candle. Now, then what I do is identify the leg candle with the high and low of that leg in candle. Any candles that close within the range of that candle are part of the basing. And they could be a base candle or a leg candle. As long as they're inside the range of the leg in candle, they are part of the basing, period. So right here you can see we got in the yellow the high and low of the leg in, closed inside, closed inside, closed inside. Then for the leg out, it's got to do 2 things. Number 1, it's got to close above the high of the leg in candle because it's got to be a leg out, and an imbalance needs to be there where there's lots of buyers and no sellers. Plus, it has to be a leg candle. So it's got to close above the previous candle's high. If that wick had gone higher, this would not be a zone. And then we want to make sure there's good imbalance. So the two candles following the leg out should also be making new highs. And then when I draw the zone is I use the top of the bodies of the basing right there and the low of the formation. So if I'm going out to a live chart, dollar yen, for instance, I'm on the 4-hour time frame. The way I would look for that kind of demand is I would start off at current price, look left and down, and look to see, is there a demand zone nearby? Well, right here we have, that's a leg. I can tell because there's my close. It's above the prior candle's high. However, this candle is also a leg, right? And the previous candle here, also a leg. So I don't have a zone in this area. It doesn't qualify. Going back a little further, that's base. Okay. That's a leg, but that's a leg in. This is a basing candle. There's a leg out with that green candle right there. Problem is we don't have the follow through. I need two new highs. It never happened. So while I do have leg in, base, leg out, I don't have the follow through, and that is not a zone. So I would keep looking back until I find what I'm looking for. That's it. Just keep looking for a zone. And if I don't have it, so be it. Just keep looking. We'll eventually find something, I'm sure. Looking through here, there's not much here. Okay, we see a leg candle here. That's actually a leg candle. Base, leg. Okay, so let's see. What do we have here? We've got possible zone. I marked the low of the leg in, high of the leg in. So that red candle is my leg in. It's closing below the previous candle's low. Base, base. Leg out is above the previous candle's high and above the leg in. One new high. We don't have the second new high. So that's not really a good zone, is it? So I disqualify that. It's got to have all the parts. Otherwise, it's not a zone. And the reason why this one's not a zone, it's actually a retest of a prior area because my next demand zone is the same. The only difference is the leg in. So right here, you can see we had leg down, base, 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 leg out to the upside. Here we have leg up, base, 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 and then leg up. So it's the exact same formation. The only thing that's different on this one is the leg in has to be above the high of the preceding candle. This is what we call a rally base rally demand zone. Okay. Easiest way to get hold of me is my email, honestly. I don't give out a phone number, but you can email me and we can talk more. So that's brandonwendell.cmt@gmail.com. Best way to get a hold of me. Anyway, so right here, going back to that example that we were just using, okay, I said this didn't qualify as a zone. Here's why. Going back, notice right there we have a leg candle. Okay. New high, new high, new high. That looks good so far. Okay, so then we go back a little bit. We say that's a base. This red candle is a base because it's touching that body right there, or range. But that green candle, that's a leg right there. So we got leg in, base, base. Actually, let's do this right. So we got the leg in, high of the leg in, low of the leg in. And you can see 1, 2 candles basing inside. This candle closes above the leg in and above the previous candle. So that's my zone. And I mark it using the bottom of the wick and then the top of the bodies. And I'll remove all my guidelines. And now can you see why that other one was not a zone? It was a retest of this area. This was a rally, base, base, rally. This was your trade opportunity. And that trade opportunity worked pretty well, didn't it? That's it. So if I'm looking for another zone below now, I just go ahead and create a horizontal line and work my way back. So again, leg right here. And we have the highs following base, 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 leg. Leg in. Oops, wrong one. Horizontal, there we go. So there's my leg in candle. I'll zoom in a little more. So we have leg in, base, 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 leg out. And again, I mark the low of the formation, high of the bodies, and remove all the other candles. And there's my other demand zone. I don't know if we ever hit that. Let's see if it come back. No, not yet. So that's my next fresh demand zone. I probably won't use this one because it's already been used. So all the imbalance in buying pressure is probably stuck there. And then for supply, it's just the opposite. We have two formations here. Rally-based drop. Okay. You can email me for more information on all this as well. And right here, you can see we have a leg in, base, base. Okay, so all the basic candles are within the range of the leg in. And then you have the leg out, which is below the leg in candle and below the preceding candle's range as well. And we should have follow through. And there are always exceptions to this. You know, I talk about technical analysis. Everything always happens except for when it doesn't. So there are examples that, you know, this happens, and there are sometimes that you get exceptions. But this is the highest probability, and because it's all rule-based, there's no guessing involved. You can actually code this, and I have coded it on several different platforms. So right there, we have the rally base drop, or the next one, the only difference will be the leg in. Here we have a drop base drop where we've got, again, the leg in is below the previous candle's low for the close. You mark off the range of the leg in, the high and low, and any candles inside of that, closing inside, become part of the basing. Then you have the leg out, which must be below the previous candle's low and below the leg in, and then you have the follow through. So those are the four different formations for supply and demand. And no matter what we're looking at, you know, again, I'm on a current chart here. I'll go back to that 2 hour that we were talking about. If I'm looking for my zones, I start off at current price and I'll work my way back. So I see we got a nice leg candle here. It's got a little bit of follow through. So let's see, we've got base, 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 leg. So there's a leg. Mark off the low of the leg in, high of the leg in. It looks like we got three basing candles, a leg out, and then it starts to go down just a little bit. Not very strong. And there's my zone. Drop, base, drop. Going back a little further, we got leg, leg, base. Yes, we might have another one here. Let's see, where's my leg in? We got base candle, the green, leg candle on the red. So I mark the low of the leg in, high of the leg in. We have two basing candles. Mark the zone. Clean it up. And we have another zone right there. And keep going. Or if I'm looking for demand as well, start at current price. You can see where we are here. We've already kind of touched this area. Might have been a zone back here. As a matter of fact, it was. You can see this is a leg right here. There's a new high, base, base, leg. We have rally, base, rally. Now we already missed this one because that would have been a great buy opportunity, right? Anyway, going back further, our next fresh area of demand. Let's see, what do we have here? This probably won't work because you can see that we've got what appears to be a leg candle here, leg candle there, leg to the downside, but base, 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 base. There's my leg in. So that's my leg in. There's a high and low of the leg in. We got 1, 2, 3, 4. Oh, wait, no, that closes below. So that's not a good zone. It doesn't work. So I can just keep looking for another zone that actually qualifies. And just keep going back until we find it. You can see why that didn't work, because right here we actually have off the low, rally, base, rally. That was simply a test of that demand zone. So I keep looking for the fresh zone. This one has already been tested as well. It would have been a nice zone right here, and you can see why. You had rally, base, 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 leg out, new high, new high. Just keep going back. Leg. That's a base. Closes inside the previous. That's a base. Believe it or not, that's a leg candle there. Closes above the previous candle's high. So now we've got two basing candles. And that's my next demand zone right there. And that's all I would do is just keep doing all that. You can see this was a good demand zone. Definitely worked out well. These are all tested, so I'm not going to use them again. And if we're looking for where we can trade, now I have two supply and two demand zones identified. The only part we're missing is trend now, which we're going to have to do another time because we're out of time. But basically, what happens with trend, it tells us what we're supposed to be doing. Okay, so we're going to wrap up with this real quick discussion. And basically what happens is with trend, you've got supply that can be used to exit longs or enter shorts. Or you got demand, which can be used to enter longs or exit shorts. Trend will tell you which you have to use. So that's something we can talk about another time when we get back together again. Or if you want to join me again, you can go ahead and email me. Best way to get a hold of me again is Brandon Wendell.cmt@gmail.com or Twitter, which you can follow me at TraderBDub. And hopefully shed some light there for you on supply and demand. I want to thank everybody for being here, and hopefully I'll talk to you again soon. So they will have the recording up soon, I imagine. You obviously got to be a member of FX Street to be able to see that. And I want to thank everybody for being here. So until next time, everyone trade safe, trade well, and take care. Thank you. I'm glad you all enjoyed it.